from Actualize Digital Assets. Welcome. Let me check first my microphone. I think it's working. So, today's show is about strategic asset allocation in the age of tariffs. So, you have heard maybe recently over the last few days how things have evolved around tariffs and how the markets have been absolutely turbulent and volatile because of the tariffs that have been instated by the US. So today, so first, let me start with a disclaimer. So this is not a financial advice. Our goal is to help you get the most insights and get visibility of the future or about maybe where things are headed will go in the next few weeks and the next few months, so you can have the right allocations and the right moves, the right strategic move. Um, as you may have heard, as of now, maybe the landscape have greatly changed over the last few days, actually, and many people in the market and many people will get probably affected by these tariffs because it will cause immediate increase in prices in many countries in the US, but also in other countries. Um, so. Uh, so the tariffs have sparked a global trade, I would say, on quotes, war. So it's not a real war, but there's retaliation and tariff increases from several countries. So the market response. So the markets have responded very negatively to this, and they dipped a lot over the last few days. And all this is because of uncertainty. A lot of markets are feeling uncertain. A lot of people are feeling uncertain, and markets don't like uncertainty. And many stocks have dipped as a reaction to all the asset the the tariffs that the US have instated over most of the countries actually in the world. The China have retaliated with a 34% tariffs on all US imports, which is a significant number. And this pushes us to think that more countries will maybe do the same. So there will be more and more fees when trading between cross borders between countries, and this means that at the end of the day, costs and expense there will be higher costs and higher expenses, and this is what also what threatens the markets is that the expectation for sales for many companies will be reduced or revised down because of the higher costs and the higher expenses for the end customer who might not be able of buying anymore. So we're switching from a world of free trade to a world of fee trade. So this is unfortunate, but we're here to help you get more visibility over how things are evolving and where are the best uh, where is the best place to put your chips and know how to move strategically to benefit from this change in regime. So as you may have, as here you can see the global markets change in the over the last few weeks and few days. As you can see, it went down up to 10%, minus 10% in Japan and in the US since the inauguration day. So that's a lot. So this obviously, if you zoom out on the macro perspective, you'll see that overall this is not significant, but it erased almost 1 year's worth of market or appreciation in the prices and in the indexes. You can see also here some US stocks that stumbled a lot after Trump's tariff announcement. So you can see that Apple, for example, Nike, Lululemon. So, for example, Nike and Lululemon have been affected bit more than Apple because they're importing a lot of goods from Vietnam, and Vietnam have been slapped by really high tariffs. I think 34, 35%, which is quite high, and this will probably that means that investors are probably skeptical that these companies will have high sales because of the high cost that they will have importing the goods and their products from Vietnam. So the expectation for these companies to for the sales prediction and forecasts for these companies will be probably revised down actually. So this is why the prices went down. Sorry, the stocks went down. So now for after see with these post tariffs allocation post tariffs era, a new game is evolving and is happening in front of our eyes, which is a game that involves tariffs everywhere, almost in every country. Sure, some countries might step back and decide to not tax any US products or reduce the taxes for US products to get themselves in return not taxed or low have low tariffs for their products when they're imported to the US. But this is overall this is not the best news that we could get, and there's even higher risks uh, for recession over the next few months. So that's why we should have a more adaptive asset allocation and be more strategic about your allocations. So so we'll dissect in this show how you can maybe more orient your allocations into alternative assets and reveal why maybe alternatives could be a solution for the near future, the near term. Um, and now also some of the what happened over the last few weeks, which is the traditional stocks that have been traditional markets that have been rattled, and the SME Swiss Market Index have declined by almost 10% post the tariff announcements, and the VIX have the volatility index have increased by 100%, basically doubled in the last few weeks. So that's a lot. Why? Because of the all the volatility that the indexes are, or the tariffs are causing. Um, Also, what was hit hard is the European also stocks, luxury stocks that dipped by up to 8% for some brands. I think this is here LVMH, Richemont, and Kering. So all these brands have dipped a lot because the European products would be taxed much higher in the US, and many European brands are exporting to the US, and it's one of the major markets. So that's why uh, it's very important to keep in mind that many industries and many brands will be affected, and we will be doing another presentation. We'll explain to you in another video which industries are probably going to be affected the most in the next few months. As you can see, also traditional assets and bonds have been also affected a lot, and you can see the yield have declined by almost 20%. So we went from approximately 4.8% to almost 3.9%. So that's approximately 20% decline over the last approximately month. So that's a lot. Um, And now regarding this traditional assets and real estate, so in Monaco, the luxury property prices have increased by 3.2% from 2024 to 2025. We think that this could be a good hedge against the volatility of the next few weeks or few months. We think also that the limited supply also will continue to support values and they won't be affected that much by the probable recession. So because also of the the fact that many properties are waterfront, which give it the strongest or a strong resilience against the market volatility. Luxembourg also prices have increased by 2.8% over the last year. And in Luxembourg, also the fact that it's a financial center provides assets or real estate in Luxembourg with greater stability. Um, and But there's a slight pressure regarding commercial real estate, seeing a slight decline in prices. In Switzerland, the luxury property prices have increased by 1.9%. The Alpine Retreats maintains a premium. Everybody who thinks about Alpine resorts have a positive idea about it, and investors will continue to invest in these assets. Urban centers are experiencing modest slowdown, but it's very moderate compared to the volatility of the market. So, all in all, luxury real estate holds steady in the major hubs, in European hubs, with global slowdowns that might happen over the next few months. So the alternative edge. So we think that precious metals could be an alternative safe haven during market turbulences. Fine art also could be a good hedge, also because its tangible assets have potential for appreciation, and also wine and collectibles. They tend to perform well in these kind of markets. Cryptocurrencies also is becoming more and more a hedge against volatility, or at least stock market volatility. So crypto in itself is becoming not just trendy, but it's a wild card to tariff rattled world, because it allows you to uh, adapt faster. So here's the historic performance for crypto, and as you can see here, it's the appreciation was over 1,000% over the last almost 5 years, since 2020, May 2020, and you can see also the uh, the SPX, the sorry S&P 500 here. You can see also it has really appreciated a lot, but still not as much as Bitcoin. You can see the differences gap is quite huge. There's also the Nasdaq, and there's the Swiss Market Index, which all have appreciated, but the rate of appreciation is insignificant compared to Bitcoin or to cryptocurrencies. That's why we think that history, from what we've seen so far in the past, and what history tells us, is that crypto tends to perform well when the market stumbles. So that's why we think that this will continue in the future. So why crypto now? So there's a lot of uncertainty regarding tariffs, and which creates market disruptions. There's a lower correlation between crypto and markets. So many people see, and we have also seen this data, that the correlation between S&P 500 and crypto and Bitcoin, more specifically, is getting lower and lower. So when uh, let's say S&P 500 or Nasdaq is declines by a significant percentage, Bitcoin tends to stay steady or steadier, or the volatility is usually less. That's over the last year, and many have seen this, and we have the data to back this up. Also, Bitcoin is decentralized and not subject to any central authority or central control of central bank. So this gives you much more freedom to use it the way you want it, and not to get affected by policies of other parties that might affect your assets. Also, the growth potential. It's an emerging technology with huge adoption upside. So for you, this is good news for you. This will allow you this asset to be appreciated significantly over the next few months or few years, compared to other assets that might not get appreciated because of the tariffs and all the turmoil and all the market volatility that it creates. Crypto and has low correlation with stocks and bonds, which makes it a tariff-proof contender. And the decentralization potential of crypto and the reality of decentralization in Bitcoin makes it a superpower compared to other assets. Um, and now you can see here the comparison of crypto versus real estate. As you can see, Bitcoin have been uh, performing quite well over the last 5 years. You can see it went up 1,130%. That's a lot. And you can see the gold in I think in red. Yes, exactly, and the rate S6, which is the real estate developers, the major stocks of real estate developers, that's the purple, and the last one, which is the blue purple, which is the Nasdaq real estate index. So you can see the real estate didn't perform exceptionally well over the last 5 years, but it gave it's a quite stable investment. So this is something that's known. Real estate is very stable as an asset, and but the returns are not exceptional. That's really important. So this is why we think it's good that the allocations could be maybe 5 to 10% on crypto, and maybe the rest in traditional assets, more sorry, non-traditional assets, alternatives, and also in real estate. So why crypto and macro maybe are friends? Because it's when macro trends go on the are more against or are rattling the portfolios. Why crypto could be a good hedge, because it's as inflation ticks up, crypto's decentralized nature makes it a hedge worth betting on, because many people could invest in this and go out of markets that are highly volatile, and crypto is less volatile now. There's also an evolution in regulatory frameworks. Maturing legal frameworks makes it a more mature asset. Now it's even an institutional grade asset, because BlackRock and major hedge funds are investing in it. There's also global adoption, increasing institutional acceptance for cryptocurrencies, which makes it much more appealing, and supply constraints. That's maybe the most important point in my presentation, which is limited issuance creates scarcity and value. The less you have of supply for a product or service, the more value it will have. Thank you very much. So like and subscribe, please, this show, and share it with someone that you appreciate. It means the world for us, and we'll see you